Merrill Chandler here, your host of the Get Fundable Fundability Universe podcast. And we're here with, once again, what time of the year is it? Oh, that's right. It's April. It must be FICO World. And I'm here with my guest and our favorite FICO friend, David Smith.
In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
So,
Hey,
David, I'm glad to have you once again on the podcast, but more importantly, just to be here. We get so much done. I learned so many things from you. It's crazy.
No, it's an accelerated time these days. We just feed off each other. I learned something from Merrill, not even related to financing small businesses. We were talking about how to be more prolific at blogging. He goes, "Here's what I do," and I'm like, "That is brilliant." So, I mean, not even this related, credit related. I've picked up on things. So
Optimize hashtag optimize everything.
Optimize everything. So no, and I've picked up on some of the customers I've talked to have some really good ideas, and they want to do some really funky things. So I'm having the best time. I always do, and I'm glad you do too.
This is always great. Okay, so last year we're in Miami, and they did like 4 city blocks of downtown Cuban Street or Cubano Street, and they sealed it off. And every restaurant, cigar bar, everything, it was like, go in, you have run of the place for all these restaurants, all these things. We're wearing the little Cuban hats and everything. Fun as hell. Guess what? We're in San Diego. Guess what we're doing? It's Superman themed, and they're doing the exact same thing. Several blocks. We just got run of downtown what is it? Gaslight District.
Yeah. And so it's the theory of work hard, play hard, right? We do a lot for our customers. We bring value. Our software brings in profit, and our customers are very smart. They work hard at what they do to help their customer downstream. So, we kind of reward that and say, hey, let's have a lot of fun. Let's do a lot of work. Let's solve a lot of problems. Let's think really hard on things. But in the evening, let's have a little fun.
All right. So guess what tomorrow night is? No joke. They've rented the USS Midway aircraft carrier. We're out there literally on deck partying. This reminds me back in 2016, my very first FICO World in DC with the Smithsonian Institute.
That was amazing.
They rented the entire Smithsonian. We're sitting there eating hors d'oeuvres in the savannah, the African savannah exhibits. It was, and then the DJ was world class. These guys know how to throw a party.
No, Nikhil is our chief marketing officer. He is.
There's a C-suite person for partying.
He is unbelievable. And again, he thinks big because our customers think big. Our product team thinks big. Yeah. And I'm not trying to sound like a commercial, but
it's legit.
No, it really is true. It really is true.
No, you guys are top of class.
Yeah.
And everything you do.
We've got over almost 1,200 people from our customer base. About 40% of those from overseas, from various countries.
It's always been huge.
With 50 countries represented. Think about it. 50 countries.
That is
and I was talking to a guy this morning, one at my table, one guy from Canada, one guy from South Africa, and we all had something in common, trying to solve credit problems, right? Yeah. And so we all had this common language to speak, and it was pretty cool.
One of the things that I've always loved, not just about FICO World, but FICO the gravitas that it has in the marketplace, because everybody knows FICO, for credit scores, but they don't know FICO for this back of the room hardware, software commitment to make things easier.
Well, when we got into the scoring business back in 1956, it was abacus. I mean, seriously, it was slide rule. It was honest to goodness slide rule engineering. But then over time, we built software to build our models. And then when we built that software, we're like, I bet you our customer base could use this.
What if it were client facing?
What if we could build this as a product? And then that led to this, that led to this, that led to this. And now we have this entire decisioning platform suite called FICO platform, because we don't know inventive names. But it's a decisioning platform that ingests data, runs simulations, does decisioning, builds models, has an AI component, has a machine language component, and does really funky, cool things for big institutions and small institutions.
Yeah.
And I just love the fact that we can serve banking, insurance.
Yeah.
Yeah.
What I love is its predictability, because here's the thing, from my perspective, I can because we've done enough clients, we've kind of done our own reverse engineering. I can predict what money needs to go through an account, what baseline balances to have, what timetables to do for your SBSS, for lender underwriting software, for all of them to go green light, green light, green light, and get an approval. It is predictable because you guys
because it's a decision engine. If you put in the same, if you put in 100 of the same applications, the theory is you get 100 of the same answers. There's no subjectivity to any of those decisions. It's all objective decision,
right?
Because it's looking at data element, data element, data element, not Bob sitting in the back room going, oh, I don't know. And
yeah, my wife, we're in a fight today, and so.
Or something I said earlier today was, if Bob goes to a conference and figures out this new metric, and then next week he's basing everything off that new thing he learned, then the people that applied last week weren't subject to that metric. People, towards this week were. I talked to a bank a couple of years ago, and they're like, oh yeah, we only let our underwriters have 3 overrides per quarter. And I'm like, and they're all holding them till the last week of the quarter.
I want to file then.
I want to file at the end of the quarter so Bob can override my crappy credit.
Right. He'd be like, I'll let that one through. They're all mine.
Yeah. I was like, so they're all going to be spent in the last, 2 weeks of the quarter. Nobody's going to spend it the first week of the quarter.
Yeah.
I said, so you kind of rethink how you allocate, overrides and such.
Okay, guys, this is a perfect example of what we talk about when, first of all, for lack of a better term, the algorithm, the modeling, it's colorblind, it's financial blind. It is literally check boxes in a cycle of decisions. And if I've said this, it's on the back cover of my book. If you know what the underwriting conditions are and you meet those underwriting conditions, who is in charge of your approvals?
That's you. Yeah. Straight up.
You are.
Straight up. Whenever I tell people who I work for at a party, I either get, oh, I've got an 820, or, oh, you prevented me from getting a mortgage. No, I didn't prevent you from anything.
I didn't do jack.
I'm sorry, man. Your credit sucks. That's on you. It's not on us. All we do is measure your suckage, and
Okay, that's going to be a new technical term inside of the SmartCo velocity funding model. We're going to measure your suckage and see what we can do about it.
But no, it's true though. And if you follow the plan works, and it works too. I mean, not a 2 out of 4, not a 3 out of 4.
Yeah,
it's a 4 out of 5.
Well,
or
so
better,
far we're at 100%.
Yeah,
we're at 100%. Yeah, here's a great metric. Last 9 months, 100% of clients who literally implemented did exactly on plan. 100% approvals from all of 7 of our top funding banks. 93% because there were a few people who said, you know what, he said ask for this, but I'm going to ask for this anyway, and then they got denied. And so I'm just going to say,
why deviate from that?
It's perfection. We're nailing this thing, dude.
And that's why I'm here. I mean, seriously, we were talking before this. If he was 70% right, 75% right, I'd still be here. If he was 60% okay, if he was 45%, I'd be looking for the back door to exit. You're not.
No.
You're well above what other people are doing.
Yeah.
So why are you doing anything else? Follow the man's plan. And it might be tough, and it might take you a while to get there.
Yeah.
And that's the struggle, right? Is correcting where you are to where you want to be. But that's the journey of a small business.
Well, borrower behaviors have a chance within 90 days to turn around on the look back period.
Yeah.
It was something fascinating that you and I were talking about that before. I didn't know 10T was coming out, right?
Okay.
But but we were already teaching our clients the 24-month look back period
Yeah.
before
Or it
10
became a thing. Yeah. No, trending is one of the new things right now, right?
Yeah.
And somebody equated this to an insurance form. Yeah, they want to know what you weighed a day, but they also want to know what you weighed last month. You know,
Right.
are you consistently 185 or did you get down to 185?
Right. And you
Right?
spent 2
And I
years
spent
at
2 years.
350.
Yeah, exactly. No, totally. And he's like, he goes, when they said that, it kind of dinged in my head. You know, has somebody fixed their problems and you see a solid trend? I'm sorry, solid trend to improvement, or is somebody ebbed
Yeah.
and, you know, been rocky? And he goes, I either want to see somebody who's consistently good or somebody who's fixed a problem
Right.
and
And
then
then held it.
held it.
Yes.
Yeah.
At that 24-month look back period, it was so fascinating because I always tease my community, my tribe. I'm always like, okay, fine, I'm right again, whatever. But the funny thing is it would be arrogant if it weren't true.
Right.
And while I laugh it off and play it off, trending data is now FICO's mainstay. I mean, you guys are moving everybody.
We're really
to
pushing
10.
it hard. And when you show like mortgage companies on the consumer side, the evidence of it, it's a no-brainer. It
What
really
is
is
it? Another 19% shaved
It's
off of failures?
losses. No losses. It really is. It's the numbers. The numbers huge. It's almost like if you don't do this, you should not be in this position. You know,
you get out of the bank,
no,
get out of the
seriously,
mortgage.
it is. And we're pushing all of our small business lenders into FICO 10 as well. Now there's some technical reasons why we can't do it immediately, but we're fixing that problem because 10 is the better option. 10 is significantly above. We have SBSS is a small business scoring system that we have. We also had a consumer solution built on the same philosophy, right? We took it down because the FICO 10 is so much better. We're competing against ourselves right now because
we kicked our ass.
No, seriously, the technology is so much better. And I'm talking to my customer base and saying, look, we're having to get rid of this product because they're just better products that we sell and it's cheaper. And they're like, well, I kind of like it. I'm like, you don't want to stick with this, you know? This is clearly a better product. I know what we all have habits on, and they're looking at the data and they're starting to make decisions to move.
Yeah.
And we're getting a groundswell of mid-tier community banks and regional banks looking at the FICO 10 because of those differences.
And see if we can get them. Remember, if we can get them on 10 trending, they're likely going to move faster towards automatic underwriting, which then moves our fundability. We now have a bigger palette of banks to pay fundability with.
Yeah. And really, I'll give the credit to the FICO lobbyists and even the credit bureaus here. The reason a lot of banks held on to an older score like a FICO 4 was because Fannie and Freddie in the mortgage place required this FICO 542, the older scores, and nobody could use anything else in that space. So a number of organizations, FICO was one of them, petitioned to update those scores.
Fannie Freddie.
So when you're at a mid-tier bank and your mortgage department is using one score and you're using another version of the FICO score, there are complexities in how to manage that. So everybody just went, well, forget it. I'll just use this old score, the same one the mortgage team uses. And now the mortgage team can use a newer score. So it's opened up the world to better, more efficient.
Absolutely. It also broke open the door to Vantage.
Come on, man.
We don't say that
seriously
word.
We don't.
We don't say that word here.
Hope does not like Pepsi in the building.
But that's the bottom line. But you guys have the installed base. You have it all.
We definitely have a 95% majority. It's not a monopoly, by the way. I'm talking to you, Senator from Missouri. It's not a monopoly. But we've got the majority.
Popularity.
Yeah.
It's popularity.
Everybody likes it because it works.
Yeah.
And even head to head, we beat Vantage Score. But yeah, everybody's moving to the newer scores because because regulations have gone away. And I think it's going to help everybody. And the difference between an older score and a newer score is that there's more gray area. There's less clear black and white because again, the technology to build those models is better and it helps everybody. Because let's say you were Midland, right? Let's say you're average. Well, the previous score would either have to score you fully credited for that average score or no credit for that average score.
Right.
Well, and let's say it's 0 or 10, right? Now we can give you a 5 instead of 0 or 10.
Right.
And so there's more, your score is going to float up a few points. If you're either really, really good, like an 820, 850, you might see some movement in your score, good or bad. I don't know.
Right.
And then, but if you're on the tail end of, on the other side of that bell curve, you're going to see your score improve.
550 to 610.
Yeah, something like that. I mean, still not incredibly great, but you're going to
it's a
see a
better
30
floor.
point move, 20 point, 30 point
Yeah.
move easily because you're getting more credit for the good that you have
Right.
instead of being punished.
Thrown out with the baby with the
Baby
bathwater.
with the bathwater is a great way to put it.
Exactly.
Yeah.
So let's talk SBSS. SBSS, small business scoring system. And I know recently we talked last year that everybody, it was kind of a mandate to upgrade everybody from version 6 to version 7.
Yeah.
What do you see happening in business underwriting between SBSS using FICO 10 or others onboarding? What can my crew anticipate is going to happen with business underwriting, business bank underwriting?
So the trends in that area, number one, everybody's going to upgrade. Most organizations are going to upgrade their FICO score or their credit score that goes into SPSS. The FICO score is a component. So it's going to improve the accuracy of that score. And that's the best legal term I can give you. Because if your FICO score gets better, your SPSS score is going to get better. If your FICO score gets worse, it's going to get worse. So it's going to be more accurate. So that's one thing. Secondly, most banks use a dual matrix kind of thing, a FICO score. Like you have to meet a minimum FICO score and then you have to meet a minimum SPSS score. So if that's both consumer and business score are better, more accurate, you're going to get better credit. You're going to get better risk-based pricing. So
and lower risk-based pricing is the fancy
rates.
term, better terms, better interest rates, higher approvals.
Yeah.
I'll translate.
Yeah.
I speak FICO.
Right. But also, even if you barely clear the hurdle, they will approve you now because they can price you better.
Yeah.
They can say, well, you're higher risk. You're good enough to onboard, but we're going to make you pay a little more until you prove otherwise. And then maybe at some renewal, they'll reset the terms.
Right.
So risk-based pricing tends to benefit the applicant, not the bank, to be perfectly honest. So another trend is analyzing cash flow.
Listen, everybody, we've talked about this extensively. Let them in on the
cash flow is king.
Yeah.
Okay. Because right now we're coming into a period to where there's a little bit, the Wall Street Journal called it a cloud of credit, to where post-COVID, and we're still in a post-COVID economy. Don't think we're not.
All the home-based businesses, everybody went home. Commercial values are falling because nobody's sitting in the buildings.
Inflation is not looming. It's impacting daily business, right?
Right.
And it's not insignificant. It's depending on what sector you're looking at, it's 20%, over the last 2 years. So the COVID's kind of pushing the economy up. You've got people who are businesses that were getting deferments aren't getting the deferments. The PPP money's kind of run out. The idle money's starting to run out. You're starting to have to repay those loans.
Yeah.
Those that did not qualify for immediate PPP wipeout are having to pay back those loans. And so you're starting to see that effect in the credit.
There's a burden coming.
There's a burden coming. Yeah.
For people who owe that money.
But also the economy is starting to show the businesses that can't adjust. The PPP money saved them. The deferment saved them. Otherwise, COVID would have crushed businesses. And
way more.
Now we're seeing businesses just kind of fall off the map again, kind of like 2008 to 2010. They kind of just disappear.
Yeah.
Not a lot of slow decline. It's a lot of cliff.
Right.
Because they've run out of money. And so cash flow. So what the banks are doing with that is they're turning around and saying, okay, fine, your credit looks okay. What's your velocity of money? What's your volume of money? What's the in-go versus the out-go? And they're not checking literally every bank account you have. They're checking one bank account. And
primary checking, everybody.
Ding, ding, ding. I mean, I cannot sing this song loud enough and with enough choir robes on. I am talking to so many banks that are like, well, we need to analyze what do you do if they're not banked with us? I was like, you get a solution like a Plaid or Yodely, and you have them sign into their bank account. It's totally secure. Don't think it's not. I mean, not everything's perfectly secure, but it's secure enough. And you give them your bank data, and they go in and they analyze, I think, the last 90 days worth of activity.
Yep.
Something like that.
Weird. 90 days of activity.
Shocker.
Remember that?
And 90 days of activity, and they figure out what your in-goes and your out-goes are, what your velocity is for deposits, what your velocity is for your out-goes. Is more money going out on a 30, 15, 45, 60-day basis where it kind of should, or is it going out in weird increments?
Yeah.
For lack of a better
Baseline
phrase.
balances plus cycle dollars equal
minimum balance. No, it is. It's cash flow. And they keep that minimum, whatever he tells you to put in there. Do it. It's magic.
hashtag new zero.
New zero.
New
It
zero.
Really is.
It works, doesn't
No,
it?
It does. And they're looking at this data. They're analyzing average daily cash balance, low balance, high balance. They're looking at these things to figure out, because your credit, it's determinant, but it's not perfect. It's determined on how you've treated your credit, not how you can repay your credit, right?
Right.
And they're looking at, repayability. How can you fund this loan, this line, etc. Also, while we're talking about money, they're also looking at how you're using that credit. Don't use it too quickly. Use bits of it. Again, talk about how he talks about how to pull the. Where would we hear that?
Somebody's got to be teaching that somewhere.
Somewhere.
There is a
Somebody's
formula.
really
It's called traffic intervals to use your new credit line in a way that trains the algorithm to say, oh, these guys know what they're talking about. Let's raise their limit.
I mean, if you grab every dollar that they just gave you and go spend it, you're never getting another
You're
dollar.
done. Yep.
You're not.
You're done.
You got to carefully spend it wisely. And the joke that we were talking about earlier is they care more about how you spend their money than you spend your money. They really do, because they want to know.
Until they give you their money, they're tracking your money. Those are the deposits.
Yeah.
Once they see that you are legit with your own money, they'll be all right. We'll give them ours, and that's where they don't care anymore. Just like he said, they don't care what you're doing with yours. They're watching you very carefully on how you spend their money, charge up, pay down.
So if you're banked with a bank that you're applying at, they already know.
Yeah.
If you're not banked, they figure it out. So have that one account so that you're not going, well, most of my money's here, but some of my money's here. Have it all go into one central place. Then it can go wherever you want it to go.
Okay. I'm going to clarify. You guys, we talk about having one checking account and that give them the thing to measure. If you have even several accounts in the same bank, you're not giving them one thing to measure. So that's your take home here, guys, is that we got to make it easy for them to give us money.
Yeah, because you're assuming they know all these checking accounts are related. You'd be surprised. You'd just be surprised. And some systems and some models can't analyze several accounts at once because they don't expect you to have. So it's give it to them how you know they can consume it.
Yeah.
And so again, listen to Merrill on that stuff.
I love it. It's like the bottom line. What's the bottom line here?
Yeah. Listen to Merrill. I hate saying it out loud a lot, but the next trend, price elasticity in small businesses. And this is where I don't know if you talk about this at all.
No, bring it up. Bring it up.
I don't know if you've gone to, and I'm going to pick on a couple burger joints, but Five Guys or something. 2.5 years ago, if you wanted a burger, fries, and a Coke, $15, $10, $11. Try going into Five Guys with a $10 bill and coming out with a burger fry. You're not doing it.
Yeah.
You're not doing it. It's $25, $20 now. But there comes a point, price elasticity talks about there comes a point to where consumers are just not buying your service because it's not worth it.
Right.
And I was talking to a group of credit risk folks, and I said, do you know that meme of we've got McDonald's at home? Which basically says we're not buying it, we have it at home, and we're going to use what we have, what we already have. That's essentially what small businesses are facing these days, is if you sell a service that I can do myself, even though that costs me time, if I as a consumer am being hit by inflation and higher prices, and my rent's 20% higher, my gas is now 47% higher, my utility bill is 30% higher, I don't have money to spend.
I have more time than I have money.
More time than
Yeah.
money. So if, and I complain about folding laundry. So I use the service. I'll fully admit I use a service to fold my laundry, but that's only worth so much money to me.
If it becomes $120
If it
a
becomes
week, then
I'll sit down and suck it up. And I hate folding laundry, but I'll
but that's
do
a
it.
perfect example.
But it's a perfect example. Same with burger joints. I can make a burger at home. I can make a pretty good burger at home for $5. I'm not buying the Five Guys, and I can buy a bag of frozen French fries, throw them in the air fryer, and it's not bad. It's comparable.
Right.
It's a trade-off. Can I make pho, whatever you want to call it? No, I can't do that. That's too expensive. So I'm going to buy that. That's, again, time trade-off, quality trade-off.
Not buy it because it's now too expensive or the new price point.
Or not buy fancy soup.
Yeah.
Fancy
soup.
Because it's gotten too high priced. So I think at some point, small businesses are going to have to face the fact that their prices, that they're going to have to lose profit to keep their prices low.
Yeah.
They're going to have to rethink their profit margins, rethink margins in general,
or optimize the business
in any way possible,
Yeah.
right? Whether that's laying people off or you'll see this, there some products are going to cheaper ingredients, right? I'm not banging on Chick-fil-A, but Chick-fil-A is like, wow, when we said hormone free, what we mean now is, they're changing.
There's some gray area.
Yeah.
You can reinterpret
what
the language is.
They had to buy, to keep their price point. They have to go to a chicken producer that can't guarantee hormone. I forget what it is. I don't want to insult Chick-fil-A, but they're having to switch.
Yeah.
Who gives them their chicken?
Yeah.
Because they can't. Nobody's buying an $8 chicken sandwich because they
Right.
had to make that trade-off. And I think small businesses are going to have to make that trade-off in order to stay in business. And I know that's not necessarily about fundability, but it really is.
Well, it actually comes into play significantly with many of our tribe are real estate investors, and the profit margin on a flip now is lower
Yeah.
because of all the material costs,
Yep.
the labor costs.
Yep.
Everything's just getting shoveled further. The
No.
shit's getting shoveled further downstream, and it is materially affecting the desire. Some people are going to wholesaling now,
Mhm.
where right now note buying is huge because you buy a note, there is no transaction other than the paper,
Right.
and you're now the bank.
Yeah.
So there is no materials involved.
Right.
And so everybody's pivoting to different strategies because of the significant increase in cost,
Yeah.
labor, materials.
There you go. I mean, that's a perfect application. But yeah, price elasticity is going to become a big issue in the next 6 months.
Yeah.
It's factoring into lots of
So
things.
speaking of prognosticating, tell us about, you've been to some bank conferences, you've been to kind of policy meetings. What's the prediction about the availability of credit over the next 6 to 12 months?
It's not good. It's less. It's again, it's if a bank lent to a C quality credit, they're going to start lending to B quality credit and ignoring the C.
Yeah.
Banks are starting to look at their portfolios and optimizing their portfolios to say, hey, if we want an average of a B, let's say straight B quality credit, but our average is a B minus. Well, that means we can't take on a lot of B minuses. We're going to have to take on the A pluses. We're just going to have to ignore everybody until that balance comes
Right
back
sizes
into
the
play.
portfolio value.
Because all of that is based around losses and 30-day delinquencies, 60-day delinquencies, et cetera. And they're having to really pivot to and put more analytics to their portfolio to figure out what they can lend. But the first initial reaction is shrink everything, shore up, stop.
Yeah.
Until we know what the lay of the land is, stop. First sign is stop digging.
Yeah.
Okay, they're gonna stop digging, and
See,
then they're gonna figure out how deep the hole can actually get.
Yeah, that's the model we use is a target, and so we say the lazy fundings, the cheap and easy money is the outer rings. We develop top-notch fundable bullseye borrowers, so that they will always lend. They will always lend to bullseye borrowers, you guys. But here's what's fascinating is that even during 2008, there was that 6 to 8 month period where it froze. There was nothing.
Nobody got anything.
The
Right.
first loans that were being given, AAA borrowers only, and
Yeah.
then they began to expand over the
Yep.
decade after that.
And on the flip side of that, not only are they gonna, and it's not gonna be that much of a retraction. I think it's just gonna be more, we're gonna stop lending to C's and only lend to B's and A's. But on the flip side of that is they're looking to manage their cash reserves. So if you have a line of credit, if you have a credit card with a high limit, they might knock that limit down if you're not using it.
If you're not
They don't
using
see
it.
enough cycle. They're going to retract that line of credit to a certain point that's more manageable. Because think about it this way. If you've got $100,000 line of credit, you've never used more than $45,000. There's $55,000 that they have to keep on the books and account for a certain percentage of that, right? In held reserves that they can't lend to anybody else, and you're not using it.
So it's a waste to
It's
them.
a waste.
Yeah.
They're losing money on this money. So they're going to pull you down to the point that they figure
Give you 50 grand out of the
you're 50,
45
you've only used 45
and give
so you
that
should
money
be
somewhere
fine.
else.
According to them, hey, you're fine. You should have no problem. You've only ever used 45,000. So they give that money to somebody else who's going to utilize it and they're going to make money off of it.
Right.
That's how they're going to stay profitable, is going through that portfolio and figuring out who needs to get cut and who
Cycle
doesn't.
your credit lines.
Yeah.
Cycle your credit lines.
Seriously. I mean,
Come to Funding Hackers if you don't know what that means,
Yeah.
or go to the boot camp. By the way, we do have a May 16th and 17th. We're back in it's called the Business Funding Summit. It was formerly known as boot camps. We're back in the boot camp game. By the way, I'm going to announce right now, we have a special guest. He's going to be giving a presentation to that Business Funding Summit. I'm so excited to have you.
It'll have some meat behind what I'm talking about
Yeah.
here, because I don't think the everything's going to change, but I'll have more evidence to prove kind of what I'm
Brilliant.
talking about and why I'm talking about it.
Brilliant.
And the next, I guess the next trend.
I just want the trend I want one of these FICO shirts. That's what
You should have told me the other day.
That's what I want. All right.
Okay.
So-
I'll try. I'll see what we can
Yeah,
get to.
well, bust me out a
Yeah.
FICO shirt. I'm going to be sporting that during the summit. Be like, what's up, play? Oh.
So the next trend is really not a trend, but more, you're going to see it more, is digital application, digital in
Finally.
engagement, where you're not going to have to go into a bank. You're not going to be handed 14 sheets of paper. Everything's going to be done online. You're going to upload your tax forms and they're going to scrape that and process it automatically. You're not going to have to wait 16 days for, an initial response. No, one of the customers, well, a group of customers, it's a consortium. They said their biggest attrition is between when somebody initially applies and when somebody actually looks at the loan, looks at the application. In that time, that 48 hours, because there's an entire underbelly of analysts. Because the first thing they'll do is run your credit. Even if you submit something on paper, they're going to key you in and run your credit. Well, there's systems, there's a cottage industry of companies that check to see whose credit has been run. And then they'll announce that to their customer base. And so let's say you're a fintech and say, hey, I want to know everybody whose Experian business report was pulled in the last 7 days. They get a list. And so then I call you and I say, well, I can give you money in 3 days.
They're
by filling out
swooping the application, the post application.
they're coming in and taking it. So by the time this loan underwriter has gotten back to them, they've had 3 people contact them to give them really crappy deals on the money, but they've got
faster,
much faster. And so it's this, I don't want to use the term vulture-like, but
no,
there's vultures.
All right, it's pro-like.
Yeah, exactly.
It's
There's
not
things
vulture.
circling that are targeting you.
Yeah.
So, and if you apply at the right bank and they run the credit that these companies are looking at, you're going to start getting these calls and you're going to have to resist the urge to say no to the 28% APRs, the 37% APRs, and hang out.
Because the money is available. They'll transfer it tomorrow.
Oh, no, seriously.
And you guys, our solution to this is to get money before we need it. We are strategic borrowers.
Yeah.
We are not, I need to make payroll tomorrow. No, we do cash flow 3 months in advance to know where the holes are in our cash flow.
And that's where these companies, these fintechs, are just making their bones. As somebody who needs that money today, I need it instantly, or else disaster happens. And you've seen this. You probably know people who have, payday loans. You never recover from that. It's really hard to get out of.
Yeah.
And same with 37% APR.
We won't name names. I
No.
name them at other
Yeah.
times, but today we won't.
And again,
We're at FICO.
they serve a purpose. I'm not saying do away with any of them, but they serve a purpose, but they're an expensive purpose.
Yeah.
And if you don't have to be in that world, why are you? So listen to what the man has to say and avoid needing money today and paying for it for the next 2 years.
Yeah. And I think that's me.
Yeah. Yeah.
You guys. All right. Any other trends? We're kind of emptied out.
Yeah, not really. No,
That's
yeah.
it. That's the entire financial universe from
Yeah.
here at FICO World 2024. Okay, David, I always say this, but this is always so much fun. It's always a revelation. Your episodes are the highest watch episodes of my
That's
podcast.
truly sad.
And I've got
That
some
is truly sad.
I've got some pretty brilliant competing seconds and
Yeah.
thirds. Always. Yours are always.
I forgot to talk about this because I
Talk
told
to
you yesterday.
Go.
So we brought in a new consultant. She knows the lending industry left and right. She's worked at some of the top firms across the country. And she said, "Hey, David, I need an overview of the SBSS score." And I was like, I don't really have time. And she goes, "Is anything out on the web?" I said, "Yeah, just go search. You can find it." She watched a podcast of ours that we did 4 years ago, 5 years ago.
Mhm.
And she's like, "Oh my God, I learned so much from it. I'm set." And she had a few questions to tweak from an insider's position, right? She's like, "Well, what about this? What about that?" Stuff that nobody is asking, right? She's asking because she's just so knowledgeable.
Right?
But I was like, that's out there on the web?
Yeah.
And
She's watching our
she's
podcast.
watching our podcast to learn about the business that I was supposed to tell her about because she's a colleague of mine. And
that is okay. That's
So,
street cred right
no,
there.
that is serious insider stuff that nobody else has. And
Yeah.
I'm shocked that the general lending public hasn't picked up on it. And I'm seriously thinking about it because there's a Fundera. If you go to Fundera's website, you can find a write-up on the SBSS score.
Right.
And I always send that out as sort of our literature because it's a third party thing. I
We'll
may
start
just
saying-
start sending that link out. I mean, why not? If
It
Sapna can
does
take
a
it,
lot.
and Sapna's worked for like Amazon Small Business Lending and a couple other companies. She's legitimately brilliant. And she's like, "Oh no, that was fantastic. I learned so much." I was like,
Done. We're gonna
So
start
I'm gonna
sending
start
out the
sending that link.
podcast.
Yeah.
I think it's podcast 142 or
No,
something.
seriously, it's I was like, I didn't even know it was out on the web. Sapna, I do apologize for not even
No,
sending it
I
to
think
you.
that's a great
So,
idea.
yeah.
And
No.
once again, we keep setting standards, both
Yeah.
not just for my community,
No,
but
it's just
for FICO.
industry leaders. Right?
Yeah.
I mean, she consults with top 30 banks, and she was like, "That's brilliant. That podcast told me everything I needed to know." And so you guys have the same stuff that she's learning.
You guys have total.
yeah.
This-
It's worth so.
It's
worth it.
not marketing when I say you guys have inside access to inside secrets.
Yeah.
That is not marketing, guys. That is
Yeah.
literally pulling back the curtain at FICO World. So, David, it's always just so freaking amazing to have you here, spend the time. We're gonna now go carouse the streets of
He's got to drink all those margaritas.
all those
Margaritas aren't
margaritas
gonna drink
in Old
themselves.
Town, right? But you guys, take home message. You have access. I have access to something that is unheard of in the borrower lender community industry, the relationship. Do not implement. You guys have access.
Mhm.
Make sure you go to the Business Funding Summit. Make sure that you funding hackers get back on your subscriptions. Make sure that you're coming to the Tuesday, Thursday meetings.
Yeah.
Ask the questions. Do the steps, and let's get you inside of all of the approvals that are possible, because the man says it. I'm not the only one saying it's possible.
100% approval. If nothing else, if that can't sell it, I don't know what does. I really don't.
It's
It really is just
and
Yeah.
those and the three people who didn't, you know who you are. You know who you
don't
are.
call them out.
You know who you are,
Yeah.
and you'll never do it again. I
And you
already know
fixed
that.
it. Yeah, you fixed it and
Yeah,
solved
never
the
do it again.
problem.
Thank
Yeah.
you once again, David.
Dude, I'm
Always.
there's a reason why I'm here. I just love
Yeah.
you, brother. So I'm
Thank
having
you.
a good time.
So much
Yeah.
so. All right, guys. This is Merrill Chandler signing off for the Fundability
guys.
Podcast. Peace.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you gotta tell your friends about this podcast because we want them to get fundable too.